Welcome everybody. This is the IOTA and Shimmer Discord server. We are here in the general voice chat, Thursday afternoon European time. We are gathering here for the second part of the DeFi education sessions hosted by BanklessConsulting for the IOTA and Shimmer community. Topic today will be token swaps, DEXs and SEXs. And everybody in the call, please mute yourself. Otherwise, I'll mute you. And I'll give it over to OX Hunter, who will be presenting today he's from Bankless Consulting. I'm sure he will give us a short intro, what he's doing here and who he is. And so I'm really looking forward. OX, please take over.
Thank you. As you guys heard, I'm Hunter. I'm an associate with Bankless Consulting, and I largely work on tokenomics stuff for Bankless Consulting. And so today I'm going to sort of give some history and present some of the basics of decentralized versus centralized exchanges. I'm going to first, and here's an overview of the sessions over the whole series and where we are. We're on our second session right now, and next week will be about yield farming, including strategies and risks. And first, I'm going to talk about centralized exchanges a little bit. I think a lot of people are fairly familiar with centralized exchanges, the likes of Coinbase, Kraken, Gemini, things like that. But something you might not be as familiar with is sort of the model of how they do trading. I'm going to go into that a little bit because it's going to be useful to compare to how DeFi trading works, because it works a little differently. So centralized exchanges mostly use something called an order book model, which is basically just a two-sided book of orders of bids and asks, which are basically buys and sells, and they get matched and filled when they overlap. And so you can see the animation. It's sort of showing you the buys and sells at each price on the x-axis, and then the volume on the y-axis. And an interesting feature about the order book is there isn't really actually a price. For an asset, there's a buy price and a sell price, but generally there's a spread between them. And you could technically calculate the price of the spread using something like the average or like error bars like you see in that diagram. But the concept of an order book doesn't actually give you an absolute price for an asset. And you'll see sort of why that's not useful when in the DeFi model. And the order books have a strength of allowing people to very specifically define their economic preferences. So they can basically set buy and sell orders at any price that they want, at any size that they want. And so it's very granular, and it's also generally very high frequency, only limited by network latency. And so it's very specific and allows you to express price preferences very specifically. But in DeFi and decentralized exchanges, it works a little differently because of some limitations I'll talk about later. First, I want to talk about some of the strengths of a centralized exchange. And one of them is that the largest centralized exchanges have fairly deep liquidity and relationships with big players in the market. And they also have generally really strong compliance. If they're still in business, they have strong compliance. So they comply with local regulations in their area, and that can be useful for a lot of people to feel like they can trade with a company that's doing due diligence about the regulations in their area, and businesses likely feel a lot safer interacting with centralized exchanges because of that, because decentralized exchanges are kind of a new paradigm with some legal gray area in some places. Another big advantage is that you can do over-the-counter trading, which is basically you can negotiate with other humans if you're buying a large amount of currency. And that can be advantageous in some cases if you have a good relationship, or you have certain things that the other party wants, or you can basically structure deals in a very customized way with another human. And you'll see how it's different from DeFi when I talk about DeFi, but it's not usually the case. And another advantage is that the trading can be very high frequency. You can connect to APIs for exchanges, and the limit at which the market can move is only limited by network latency. And so people can do things that you can't do in decentralized exchanges, which I'll talk about in a little bit. Now I'm going to talk about some of the weaknesses of centralized exchanges, which are, well, I guess the first one's pretty obvious, that they're centralized. And the problem with them being centralized is that the leadership is generally localized in a certain area. And so they're beholden to the local governments and even the CEO of the company, like the whims of the CEO at the company. And also, their infrastructure is hosted on Web2 platforms, which can break and have single points of failure. And so that is a general weakness as well. The next one is that they're custodial. So they're generally, you don't actually own your crypto assets when you deposit on an exchange. You own a legal IOU, which is basically backed by whatever jurisdiction the exchange is in. And so you're sort of missing on the core value prop of blockchains in general, being able to custody your own assets. But in the current environment, it might be a practical trade off to do this for newcomers. I know KB had mentioned in the previous session on wallets that it's a good option for beginners to use exchanges, and I think that's true. And but in the current, as a principle, being forced to allow an exchange to custody your assets is generally a bad thing. And I think in the future it will be solved by having something called social recovery wallets, which are still maturing right now, which is basically you can create a wallet that's custodied by who you choose. So you could choose maybe family, friends, or people you trust, and even maybe an exchange is one of them, which would allow people to custody their assets a little safer and get some of that benefit of being able to recover. But they can consensually choose who they want to choose to help them recover. And another weakness of centralized exchanges are that they're permissioned. And so, depending on local regulations, generally have to have KYC, and you're at the mercy of their terms of service. And access to their APIs and stuff is permissioned. And essentially, it's just a person between you and the other traders, and it's not peer to peer. And the last one is the opaque execution. So some exchanges obviously will provide execution data about which trades are happening, but it's a Web2 infrastructure, so you're basically just trusting their data at that point. And it's a black box. Your order goes in, it gets filled, and some people might remember the whole Robinhood fiasco with the payment for order flow a couple years ago. That's sort of an example of the centralized exchange being able to sort of control the flow and doesn't have opaque execution. And I'm going to stop there for a second before I go into decentralized exchanges. If anyone has any questions about the centralized exchange model.
Just adding that you can also use the chat here. So we have a chat in the Discord. On the top right corner, there's a little show chat button. So if you don't want to speak up, just post your questions in the chat and I will just read them aloud.
Awesome. Yep, let me know if any come up. I'll move on to the decentralized exchanges. So I think it was useful to talk about the centralized exchange order book model because it sort of informs the design of decentralized exchanges, and it does so because it's not possible to use order books really on blockchains. And I'm going to explain a little bit of why that's the case. One of the main things is it requires an active actor to match those bids and asks that I talked about. And this is sort of a nuanced fundamental design of a lot of blockchains, but DeFi was born on Ethereum. So I'm going to talk about Ethereum in this case. And basically, Ethereum smart contracts have to be called by an account that signs a transaction and pays gas. So you can't have a smart contract automatically execute something itself. And there are solutions for this, but they're not on chain. The solution would be oracles. So there's services like Chainlink or Keeper, or other oracle networks that can act as sort of automated bots, but they're not necessarily secured by the Ethereum protocol layer. And so you can't really match bids and asks trustlessly like in the traditional order book model. And another issue is that there isn't an absolute price at any time, like I talked about. You could technically, like I said, calculate the price with the spread or use a market buy price or market sell price. But in terms of other DeFi applications being able to read the price of something, it's very important for the ecosystem to be able to permissionlessly build lending applications and all kinds of structured products and financial tools to be able to always have an absolute price for something. And also for low liquidity tokens being traded, there could be a case of there being a one-sided market where there's no asks or no bids. And that creates another case where it's really hard to determine what the price is of an asset. And if you're using that data or you want to trade low liquidity tokens, it's kind of hard with an order book. It's also too low frequency to be efficient for order books. Basically, you can think about the block time in a blockchain as like the speed of light of the universe. And so there's a fundamental limit of how fast a blockchain can move. And in Ethereum, the block speed is kind of too slow to have an order book and make it be efficient. And now I'm going to talk little bit about how DeFi solved this problem with AMMs. And this is sort of just a high level overview. Basically, instead of just having two actors, buyers and sellers, and their bids and asks being matched, there's a new actor in the AMM model, and that would be the liquidity provider. And so there's still the traders who buy and sell, but there's an additional actor who is the liquidity provider. And the liquidity providers can put equal amounts of two different tokens into an aggregated pool. And basically, they're saying that they're willing to buy token A at any time and sell token B at any time, and vice versa. So if a trader wants to come in and buy 10 of token A for token B, they can come in and the liquidity provider will give them that 10 of token A and take 10 of token B. And looking at this model, a couple of questions come up. One is, how do we know how much of token B it costs to get token A? And another one is, well, what happens if one of the tokens runs out? What if someone buys a bunch of tokens and they run out? And this is where one of the big breakthroughs of Uniswap comes in, which is the price model that's used to price assets in these pools. So a liquidity pool, like I said, consists of a balanced pool that anybody can deposit into of two different tokens. And these people who deposit these tokens are signaling that they're always willing to trade one token for another token. And that price is determined by a mathematical curve that was popularized by Uniswap. And the curve is x times y equals k. And the x is the number of token A, and the y is the number of token B. And then k would be the result of that. And if nobody adds liquidity, then k will be constant. So if you have the same amount of tokens on each side, and somebody comes in and keeps trading 10 tokens, 10 tokens, 10 tokens, you can see that the price asymptotically approaches zero. So it never actually touches zero. And this solves some of our issues I talked about before of there always being a price. And tokens not running out as well. Yeah, and it also basically guarantees liquidity for any asset pair at all times, but it doesn't guarantee a lot of liquidity, right? It asymptotically approaches zero. So if you have an ETH pair with something else, somebody starts selling that other token, then you're going to get less and less ETH to the point where it's basically zero, but not actually. So it allows trading to always occur, and that's really important. And I'm going to stop here if there's any questions about the pricing model, because this is usually sort of one of the big concepts that takes some time to grasp sometimes.
Is that a question? I don't see a question in the chat currently. Is this kind of clear for the audience what is basically described here?
Yes, can you explain what happens in a lack of liquidity when there isn't liquidity? That because it sounds like the liquidity providers is very important. So I guess maybe showing what happens when there isn't liquidity in a DeFi situation, like how does that affect things negatively?
Yeah, I'll definitely get to that. I have a slide on liquidity coming up where I have some graphs to sort of explain that. But yeah, just in terms of the pricing model, I guess I can explain this diagram, what it's doing right now. This is just a generalized example of a pricing curve. If you're assuming liquidity is constant in this case, if somebody wants to trade a certain amount of apples for a certain amount of bananas, the amount of bananas that they get for a certain amount of apples is determined by this curve in a single trade. And so when somebody makes this trade, and this sort of hints at why liquidity is important, but as you can see by the curve, the more apples that they trade, they get less bananas per apple the more that they trade. Yeah.
Huh?
Someone asking a question, or are they just not muted?
No, they weren't muted. I muted. It was not
Cool.
a question.
Cool. And this is sort of
A
what
question from the perspective of a liquidity provider. So if I was to provide, let's say, some bananas into the pool, essentially, since, can you go back a slide?
Yep.
Essentially, in this case, the price of a banana, it would drop, right? Because there are more bananas available.
Well, in this model, I guess in this model, technically they're buying bananas. Sorry, I got that backwards. But yeah, so the price of bananas would actually go up because they're buying bananas for 61.8 apples, as you can see. But yeah, I'll get into liquidity. My next slide after this overview is actually liquidity positions and sort of how they work. This is just an overview of Uniswap, basically, of how a trade works. So the liquidity providers provide liquidity. If somebody makes a trade, it moves the price down the price curve, and so there's always a price for these assets. And yeah, I'll get to the liquidity positions now. So generally, and there are cases like on the newest version of Uniswap where this gets a little more complicated and isn't fully true. But in most cases, and the most common is that generally to enter a liquidity pool, you need to enter with a proportional amount of each token. And in the case of something like Ethereum in US dollars, right now, if Ethereum's 1,500, if you put in one Ethereum to the liquidity pool, you also have to put in $1,500. And this is to keep the pool at a balanced ratio. And like I said, there are cases like on the new Uniswap v3, you can actually customize this, but that gets a little more complicated. And the concept is generally the same of having a balanced pool. And so basically, as a liquidity provider, you add an equal amount of those tokens, and you get a receipt that basically gives you ownership of the percentage of the pool based on the funds that you put in. And liquidity providers collect fees for a percentage fee for every trade made. And as you can see here, more liquidity decreases slippage. I'm going to get into the specifics of that in the next slide, which is slippage. Yeah, but this is the general concept. And so you get pool tokens and these are also composable as well. So in some cases, you can deposit them places and get yield. That's sort of what happened a couple of years ago with yield farming. In some cases, you can borrow against these. they're basically composable products in the DeFi space, these pool tokens. And I'll talk a little bit about slippage now. And so this is sort of explaining what happens to the price as more liquidity is added in a sort of dynamic way. And I'll just explain slippage quickly. And slippage is how much the price deviates due to your trade. So if you make, because the price has to follow this curve to always maintain a price that people can see and always allow for buying and selling. If you make a very large trade, the price actually changes over the course of your trade. And this is the same in order books, but it's just a bit of a different equation here. It's a defined equation instead of basically the size of volumes in the order book that you can get through, which is very discrete and customizable. But this is a constant equation. And so first you can see, so this is the curve I had showed earlier, the price curve. And you can see this orange line is adding or subtracting liquidity. And so you can see how the equation changes as more of each token is added. It sort of flattens out as it gets larger. And this is for the same price. And the consequence of this, and the price is the slope of this line, by the way. And the consequence of this is as you add more liquidity, the slippage for a given trade decreases in a pool. And so, as an example, both of these are 5-unit trades. And I have one curve which has less of each token in it and one curve that has more of each token in it. So you can sort of see this is more concave than this one. And for a 5-unit trade, the slope of this price, which is the price, the slope of this line changes much more dramatically than the slope of this line in a 5-unit trade. And so this is trying to basically illustrate how important liquidity is to keep price stable for a given trade. So a lot of problems that projects have starting up with tokens is that there might not be enough liquidity. Maybe a buyer wants to buy $1 million of the token, but because there's not enough tokens on each side, if they did that, it would shoot up the price like 1,000% or something like that, and they wouldn't get a good deal from the original price. And so, yeah, just to recap, the slippage is how much the price deviates from the price before you made that trade. And I also gave an example. Something to watch out for when you are trading is generally decentralized exchanges allow you to set something called the slippage tolerance, which is basically how much price movement you're willing to tolerate to make the order execute. And so if you set it to 1% and it turns out that actually the price is going to move 1.5%, then the decentralized exchange won't execute that order. And it's hard to know exactly how much the price will change because people can all submit transactions to the same block. And I'll talk about a little bit about that in the MEV section I have. But yeah, this is slippage if anyone has any questions.
Nothing in the chat so far. Clear for the audience, it seems. Or any questions around?
Cool. And yeah, I just wanted to highlight again how important liquidity is to decentralized exchanges for their product to be used in a major way in an ecosystem. Yeah, especially something like if you're working for a DAO and they'll pay you in a token, then if you sell a lot of the token, then you might not be able to get the same amount of money out. And so this is also why you have to be careful with tokens. If you buy a certain amount of a token, you should probably check the liquidity on decentralized exchanges to see if you how much money you can actually get from selling that token, because sometimes they're very low liquidity, and if you sell $1,000 of a token, you'll only get $1,000 of the current price. You'll only get like $500 out of it because of how these curves work.
There I have a question. How actually how would I check the liquidity? Is there Is there somehow a given amount on a deck? So let's say I enter Uniswap and I want to trade a token against ETH. Is there basically Uniswap is telling me, okay, this liquidity pool has currently $5 million in it, or this is a high or it is a low liquidity pair? How can a user basically know this?
Yeah, so they do have statistics like that, but it's a little less intuitive. Have to calculate it from that. The easiest way is just to go to the actual Uniswap or other decentralized exchange page, and they let you type in any amount of token that you want, even if you don't have the token. So you can go to Uniswap or some other exchange and sort of be like, I want to sell 1 million of this token, and it'll show you how much the price will change if you sell 1 million of that token. Even if you don't have 1 million, you can just type it in the box and it'll auto update and show you what the slippage is.
Ah, cool. So that's
Yeah.
basically a good way before you actually enter a trade that you can basically simulate the potential outcome. And then if you see, like you said, if you see the price will change 12% just from my small trade, then you are very likely on a low liquidity trading pair. Yeah.
Yeah, exactly. Next, I'm going to talk a little bit about impermanent loss.
So quick
Yeah.
question. With a DEX, can you preload a DEX with liquidity? So if you set up a DEX and you're like, I guess you're just immediately putting in your own yield, are there any DEXs that have preloaded liquidity?
That's a good question. I'd imagine there are. I'm trying to think. Maybe something like Pancake Swap, like Binance type stuff. Maybe I don't know any specific examples, but it's definitely possible. You just have to have the liquidity, right? And
Yeah,
yeah,
I think
yeah, you go for it.
I think basically that happens quite often as far as I know, if you want to get a token on decentralized exchange, very often you are required. Let's say as a project, you want to list your token somewhere. Of course, it's permissionless. You can do it, but you very often need to provide the liquidity pool and set it up with a basic amount, either of your tokens or go into a kind of a deal with the DEX that they provide the other side of your so you provide your own token, but somewhere, let's say the USDT or something needs to come from, and so either you provide this also from funding or whatever you have, or you have to go into a kind of a deal with the decentralized exchange that they provide the other side of your trading pair to make a minimum stable market available.
So, for example, if on the 28th, when the biggest day in IOTA history happens, right? Start Shimmer. Will there be a DEX available for people to trade? And it because I know a lot of us are all getting airdropped, right? But the question is, how does that turn into value? And is there going to be a DEX already available for us to trade that pair?
I don't know. I can't tell you if this is going to happen, but usually I think when a DEX starts trading with an important pair, they usually will have a setup liquidity pool ready to go, because otherwise or they would just have to wait until enough liquidity is provided by the users until they open up trading for this pair. But let's see. Um, yeah, we'll know.
Yeah, and on that note as well, generally, and I'll talk about this a little bit in the next section. Actually, like I had mentioned, the percentage of fees for every trade goes to the liquidity providers, and so their income is basically dependent on the volume. And generally, when coins first launch, there's a lot of volume, so it's a great opportunity to provide liquidity and capture those fees, especially if there isn't as much liquidity. I know a great example of this was the ENS token airdrop. Because of how fair it was, I'm pretty sure they didn't really have any liquidity that they provided themselves, and so it was all individuals. And so because it was a low liquidity situation, people were really incentivized to add liquidity to capture those fees, because not a lot of people had a large amount of the token to put in, and a lot of people were interested in it and traded it a lot. And this sort of leads to the concept of impermanent loss, which basically describes the opportunity cost versus holding the two initial assets. So for example, if you have Ethereum and USDC, one Ethereum, 1500 USDC, and you put it into a liquidity position, you might have actually been better off just holding, in dollar terms, just holding the initial two assets. And this is because the liquidity providers are always selling rising assets and buying falling assets. So they're kind of always doing a quote unquote bad trade. But it's not necessarily a bad trade. There could be situations where you're like, I want my portfolio always to be half Ethereum, half USDC, and in that case, it's basically auto rebalancing for you to the preference that you have. But if your goal is to just make as much money as possible, then it could be the case that you could have made more by just holding the two assets. And this is offset, like I just talked about, by trading fees. And so there basically needs to be enough volume within a certain price range over a long enough period of time to be profitable versus just holding. But that's not to say you'll lose overall value. It's just compared to initially holding. So if something like Ethereum gets a lot more valuable, and you have in a position of half USDC, half Ethereum, you're not going to lose money from your initial position. You'll gain money because Ethereum's going up in value. But you could have gained more if you just held in a lot of cases. And so this is sort of an example of how providing liquidity is actually a lot more complicated than a lot of people think. And there are services that try to aggregate and manage liquidity that are built on top of different things to make it a little easier. But in general, you kind of need a strategy going in. It's not really a great passive game to play unless the prices of the both of those both assets are tightly bound for some reason, like stablecoins. You kind of have to be active when you're providing liquidity, because if the price changes a bunch and you're just looking at for profit, then maybe you could have done better just holding. So it kind of needs to be within a certain range for the fees to offset the impermanent loss for a certain amount of time. And also sometimes this impermanent loss is attempted to be offset by yield farming, which is basically what I was talking about earlier, where you can, it's becoming less in vogue, but you can deposit a liquidity position and earn the native token at a certain APY, and that'll help offset the impermanent loss that might be faced by liquidity providers.
So, this might be a stupid question. So when I stake, if I'm on Binance, okay, and I'm staking and they're giving me a 5% APY, is that APY then being paid in that native token kind of going to counteract any impermanent loss, or do I not have exposure to impermanent loss because that's essentially what Binance is taking on, and I'm just getting a percentage of their percentage?
So it depends which token you might be talking about. So there is the concept of staking just a single token. And so generally, if you're staking just a single token, I don't think Binance necessarily allows you to stake liquidity positions. I think it's mainly single tokens. It's sort of a different ballgame. It's just, I mean, you could stake tokens for many reasons, but a lot of platforms do it for security reasons like proof of stake. And so it's not related to providing liquidity. Like I had said, this has sort of gone out of vogue lately, but still happens sometimes. And it's generally just done on decentralized finance and not on exchanges.
Thank you.
Just for the impermanent loss is something that is there basically a risk of, let's say, getting liquidated with your liquidity provision if there are rapid or really monstrous price movements and you basically have been providing liquidity in such a pair?
No, you can't get liquidated. It would just be worse off than if you had just held the initial two assets. And so the reason why it's called impermanent is because actually if you're just trying to make the most amount of fees as possible, you actually want the price to move a lot because that means a lot of people are trading the tokens that you're providing and paying fees. But you also want it to return back to the initial prices that you provided the liquidity at. So, like best case scenario, you provide these two tokens at a certain price, and then it goes wild for a long period of time, and then returns back to that initial price because you'll own the same ratio of those tokens, but more of them because of the fees that were accumulated.
Yeah.
And so, that's why people call it impermanent. And if you withdraw your liquidity position after like a big upward movement, then you've technically locked in your opportunity cost loss, if that makes sense. Yeah.
There's impermanent loss. Is there kind of the inverse as impermanent gain?
No, it would, because you're always taking because as a liquidity provider, you're always taking the quote unquote losing side of the bet. There's not impermanent gain. Like I said, fees or yield farming attempts to offset that. So if you stay within a certain price range for a certain amount of time, the fees could far outweigh the potential opportunity cost versus holding the initial assets. And like I said again, this is the opportunity cost versus holding the original two assets. So you're not actually losing value in your position. It's just compared to if you had held the two, which I sort of take a little bit of issue with because it's assuming that somebody would rather hold the two assets versus provide liquidity. Because, like I said, there are many cases, and I'll show some examples of it being preferable to always have your portfolio balanced in a certain way. So it kind of real time balances the portfolio with trading fees on top of it. But
so it becomes important if someone wants to be a liquidity provider to really assess which DeFi platform and how much fees they are paying.
Correct. Yeah, it gets fairly complicated, but the general principle is that there is some amount of price range that if a trading pair stays within that price range for a certain amount of time with a certain amount of volume, the fees will be higher than the potential impermanent loss in the future if the price of one asset goes up like 50% or something. And there's sort of market dynamics that try to balance out. Like if people aren't making money compared to holding the two assets in a certain position, maybe they withdraw their liquidity, and then the people that keep their liquidity get more percentage of the fees, which offsets the impermanent loss. So there's some subtle market dynamics there as well. We talked about the most basic, generalized, and common AMM model that was popularized by Uniswap. And it consisted of a pool of two assets that were equally and priced with a curve. And so these different features of an AMM can and have been changed to suit different specific use cases. And I'm just going to run through some of the modifications that have been made on this model just to fit certain use cases. And the first thing that you could imagine doing is, instead of using the xy equals k curve, which is fairly simple, you can use any curve you want, basically. And so this is what curve did. Is you can see the blue line is the price curve that curve decided to go with, and the purple dotted line is Uniswap. And then red dotted line is just for reference. This isn't used in any DeFi platforms because you could run out of assets on one side, and that's why you can't really use that. But it's interesting. You can see about the curve is this is used for stablecoin pairs, and it's better than the Uniswap one because within a certain trading range, it's much flatter. And this is making the assumption that stablecoins should be the same value at all times. And so you get less slippage if you assume the assets should remain the same value with this model. But there are no free lunches. And by doing this, you actually bend the curve at the edges in such a way that if the stablecoins do depeg significantly, then the price will change rapidly at the edge. And so you're sort of trading off this expected range stability in terms of slippage for getting better trades versus the tail end, which it's kind of a good assumption, because if something does depeg significantly, it doesn't matter if it depegs a lot. Like if it depegs past 50 cents or depegs past 25 cents, like it's a pretty binary thing when a stablecoin depegs. So it's a fairly good trade-off to make. And you can see Uniswap's curve is more generalized for more kinds of token pairs. Any questions about the stablecoin curves? And you could use any curve you want. So people are still experimenting with what curves work better for different models. Yeah.
And this is basically what I mean. The curve is the protocol. People might not really know, but that's basically they use modified curves on that compared to other. And do they also offer kind of a lot? I know Curve offers a lot of different options, so they basically are offering different curves for those stablecoin pairs.
Yeah, so this is specifically the stablecoin one, but in pairs that aren't stablecoins, and also within the stablecoin one, I believe that they allow people to deploy pairs with different parameters, like you said, like be able to adjust different parameters of the equation. But like I said, again, unfortunately, there's no free lunch, so you're kind of optimizing for a certain case, a practical use case. Which has proven very successful for Curve because they do a lot of decentralized stablecoin trading.
Yeah.
Moving on to the next one, the other principle that we had laid out for Uniswap v2 is that the pools were balanced 50-50, and you can actually adjust this as well, which leads to interesting pools of, let's say, 95% Ethereum, 5% USDC, or 95% your favorite project token, 5% USDC. And this is just an example of the permanent loss curves from each split. And one of the consequences of changing the weight of the pools is that the liquidity providers are less exposed to impermanent loss because their position is more in one asset than the other. It's not equally balanced. And so that could be good for liquidity providers, or if a token doesn't really have a lot of Ethereum, they don't have 50% worth of Ethereum or USDC to supply to their token project they're launching. you could do something like provide 80% of the position in your token and 20% in stablecoin or Ethereum. And the trade-off is that there's more slippage for traders in a model like this, just because the liquidity is imbalanced, but there's less impermanent loss for liquidity providers.
Potentially higher fees because of the slippage then also? Yeah, but like...
Well, it might actually be less fees because LPs experience less impermanent loss, so they need less fees to offset that. So yeah, and this was popularized by Balancer Protocol. We use this pretty heavily. Yeah, next I'll talk about, in the initial model, I described 2 assets, but you can have n assets. You can have as many assets as you want technically in a pool. The interesting thing about this is it allows exposure to multiple assets for a liquidity provider, but it also like more tightly pairs a couple assets. And so Curve is famous for this. If you make a pool with 3 stablecoins in the pool, then you'll basically get the volume for all those 3 stablecoins trading against each other. And it more tightly ties the prices of them to each other because they're priced in terms of each other. And if there's a lot of liquidity, then you can always sell one of the tokens for one of the other tokens. But a trade-off with doing this with something like stablecoins is if you have one risky stablecoin in a 3 stablecoin liquidity pair, then if one of the stablecoins depegs, then your liquidity position is basically screwed because people will come in and arbitrage and basically buy up all the 2 good stablecoins with the worthless stablecoin. And so it exposes all the assets to each other, which is more risky, but also...
Soy yo. ¿Qué hacéis?
Yeah. And you can get really interesting if you...
No ha querido bajar esta tarde.
Easy write-up, please mute. Okay.
Yeah. It gets really interesting if you combine some of these factors. Like if you combine weighted pools with multi-asset pools, you can get something that Balancer has, which is kind of like a liquidity position tailored to a portfolio that you'd like. So if you want like 80% stable coins, 20% Ethereum, something like that, there can be a Balancer pool created that is that composition, and you'll be able to provide liquidity for the ecosystem, maintain a ratio of assets that you feel comfortable with, and earn fees, trading fees for that. And so it's kind of a cool concept of being able to combine these things. Yeah, those are the 3 different examples. I don't know if anyone has any questions before I move on to MEV.
So what's the negative effect if, for whatever reason, liquidity providers see it as too much of a risk and they'd rather hold the tokens? How is that going to affect the DeFi platform if there's very little liquidity providers available?
Yeah, so it makes it so the token holders that want to sell can't get a lot of value compared to the price now. Like if something is 20 cents and they want to sell a bunch of it, then they're not going to get 20 cents for every token. They're going to get less according to the slippage. And the other way around, if somebody wants to buy, like a company wants to buy a lot of a token and there's not enough liquidity, it could shoot the price up really high and they wouldn't get the 20-cent deal. They would probably be buying for an average of like double that or depending on how much liquidity there is. And so, yeah, it just increases volatility a lot and doesn't allow people to get the value of their tokens out.
One thing I've been trying to conceive in my head is like looking at someone like Celsius, where basically they gave loans, and in one way, I think the standard user would say, "Hey, I'm going to put this up as kind of liquidity, but and if I'm going to put Bitcoin so I can borrow USD. If Bitcoin price drops, then you liquidate me to cover my loan." Problem, it seems like, is that they went and did special loans to certain big, multi-billion VCs and said, well, we're going to allow you this very low Bitcoin price. Basically, there's no risk. But then, of course, Bitcoin dropped so much and they couldn't cover the loan. So then they went kind of insolvent. Whereas in DeFi, and I asked one or two DeFi platforms, like, how can this be prevented? And they said, well, because of smart contracts in place, there's no kind of special circumstances. So if the Bitcoin is being provided on that loan and the price drops, then it automatically gets liquidated. However, one risk in that scenario would be, is there liquidity? If there's no liquidity and that smart contract acts, well, it's just going to actually be selling lower than that sort of break even price in that loan because there's just no one selling, right? So there's still that risk that if it's a real crazy bear market day where there's a 50% drop and, you know, in the loan smart contracts, that DeFi platform is only as safe as the liquidity that it's being provided. Would that be like a general kind of concept that can be used?
Yeah, you're absolutely right, and that's a pretty deep concept and a good thing to understand because that is how bad debt is created in decentralized platforms, and it's because individuals generally are providing liquidity. It can be fairly risky if it's low levels of liquidity and one person's providing all the liquidity. Like you could have a market of debt that's perfectly fine. Like it's like there's enough Ethereum or whatever in the pair to sell them and liquidate. But if that person just decides to pull the liquidity out, then all the debt is bad. And so it's very true. And so that's why Ethereum and Bitcoin, obviously, like wrapped Bitcoin, obviously have enough liquidity to on smart contracts. Generally, people don't think about if there's enough liquidity to provide loans in those assets because there's a lot of liquidity.
Have you seen on DeFi platforms? I guess my taking from that risk that like DeFi is better than centralized. However, the key variable is there enough liquidity? If I'm a user, I want to use a DeFi platform that has a very clear, transparent, hey, this is how much liquidity we have today at this second, you know, like a dashboard. And this is how many liquidity providers there are. Do you see that on most exchanges? Because, you know, like when there was a time that potentially IOTA was going on Celsius, and I kept asking people like, well, is this safe? And the return answer would be oh, they're the biggest provider. They have multi-billions of dollars, you know? And it's like, but little did people know 60 or 70% was to one single company that really had no call on it, you know? So, you know, I just wonder and I haven't looked too much at DeFi platforms, but are they very transparent about their liquidity holdings? Or I would hope that organically users and more DeFi platforms that come out, you know, put that on the dashboard and kind of show like, hey, we're safe. We have X amount of liquidity, but not just by a few providers, by several providers, you know. And then if people see that start to change, they can then at least make the decisions whether they want to stay in those platforms or move to other ones.
Yeah, exactly. Yeah, some platforms do have that, but if they don't, it's still visible on the blockchain, so people can get that data and make a dashboard for it. The hard part, like I said, of that challenge of that is it's not enough to know how much liquidity there is. It's kind of also you kind of also have to know who owns the liquidity, and so a very good move for lending, I think, is if a protocol owns their own liquidity in their treasury and they lock it like programmatically for a certain period of time, then you know that you can have a debt market of a certain amount because you know the liquidity can't be moved. But yeah, I'm coming up on the end, so I just want to get through some of the MEV stuff. So MEV is basically any value that can be extracted by actors based on how a blockchain orders their transactions. And so this is sort of similar to something like payment for order flow in stocks, if you've heard of that, like Robinhood again. Like if you control the order of how transactions are executed, then you can do a lot of interesting creative things with that to make money. I'm going to talk about two of them and also talk about the fact. So Ethereum has an auction for the order of transactions. So there's a whole MEV searcher community that tries to bid to get certain transactions included to extract the value. But as far as I'm aware, Shimmer has unordered transactions, and so some of the the miners or the validators can't order their transactions however they want, and so some of these MEV opportunities don't exist, and in a lot of cases, the negative ones come from ordering transactions. But one example of MEV is arbitrage, which is basically bots buying an underpriced asset from one decentralized exchange and selling it for more on another. And this is generally considered a good thing because it equalizes prices across markets, and that's healthy. And somebody has to do that if there's fragmented liquidity to sort of have healthy markets. And yeah, and so generally this happens in the same block in a blockchain in Ethereum, for example. If you can order transactions, somebody would want to get their transaction as fast as possible before somebody else does it, and they can spot an opportunity in the same block that they execute their opportunity. So there's virtually zero lag time between prices between decentralized exchanges getting equalized. And even on a platform like Shimmer, where the transactions are unorderable, arbitrage still exists. It's just not in the same block. It would be block after block. People will equalize the prices, so that's a good thing. This is an example of something that requires ordered transactions to execute. And this sort of draws back on the concept of slippage that we talked about. If you see that somebody's placing an order and they'll tolerate 1% slippage with their order, somebody can go in and buy the asset up to that tolerance that person's going to buy it at. So increase the price that person's going to pay for those assets by buying it beforehand. And then immediately after that person buys it for the 1% higher price that they allowed in their settings, the person will sell the asset for the profit because they bumped up the price by buying it. And this is generally considered predatory and really not adding value in general. And it's a problem on Ethereum and other blockchains where you can order transactions, something to watch out for, make sure your slippage settings are within a tolerance you're comfortable with. And so it's generally it's not value adding, but it's also consensual. If people understand slippage settings, then it's generally not profitable to do this to very small trades just because of gas fees and a lot of other reasons. Sorry if I'm speeding up a little bit or getting to the end. I just want to quickly the strengths and weaknesses and take any questions. So the decentralized exchange strengths are that it's trustless. There's no counterparty risk. You're just interacting with smart contracts. And I'll talk about the weakness of smart contracts in a second. But also it's transferable, transparent. You can see all the orders and the code on the blockchain that's executing the order, so you can see exactly what's going to happen, and it will happen in the way that you expect. It's permissionless. There's no gatekeepers blocking people. So theoretically, it should be capable of less fragmented liquidity, in my opinion, than traditional markets, because anyone in the world can provide liquidity and aren't sort of bound by local jurisdictions. Something else really important is that it's composable, the way it's written, smart contracts. You can build on top of exchanges without their permission, which allows for huge amounts of network effect in building different ecosystems. And I kind of think, if anybody remembers when APIs were first becoming a big thing, they were open and free, and like you could use Twitter's API, and everyone was like, "Oh, the internet's going to be amazing. You can build permissionlessly on Twitter and do whatever you want." And then slowly, companies started shutting off their APIs for things like that, and sort of that dream sort of died. And so, I sort of think about this composability as continuing that, allowing for that dream to actually happen. And talking about the weaknesses a little bit, there is exploit risk because code is law. If a code has a bug in it or an exploit, then you could lose your funds. And so ways to minimize this risk is make sure whatever you're interacting with had a smart contract audit. And honestly, I've seen fake smart contract audits. So a lot of times it's worth even following through and looking at the smart contract, making sure it's on the website of the company they say it is. And also another good rule of thumb is thinking about the Lindy effect, like, which is basically the longer something's been around, the more trustworthy it is. And it's especially the case in DeFi because basically the entire value locked in a protocol is sitting there like asking for attackers to exploit it. The larger the amount of money gets and the longer amount of time, the more opportunity hackers would have had to exploit that. So if you have $100 million sitting in a protocol for a year, you better believe a lot of hackers were trying to exploit that for that whole year. So there's sort of a rule of thumb there with how long something's been around without being exploited. Another weakness is technical limits, which is the block times are sort of like the speed of light limit for decentralized exchanges. And block times can be shorter or longer depending on the blockchain, but it's generally longer than just pure network latency. And different chains have different architectures. So an example is in the Ethereum EVM, smart contracts must be called by somebody that pays gas and signs something. And so that's sort of a fundamental building block of Ethereum that in a lot of EVMs that change sort of what you can build on it. And this sort of leads to complexity, which is that these concepts are generally the structure of blockchains is a new paradigm from the ground up. And so it's kind of, in a lot of cases, you have to fully understand the fundamental building blocks to sort of know what what's happening. And so an example is the MEV. If you set your slippage to a certain level, you might not know, and somebody bumps up the price to your price limit to extract value from you. And if you knew about it, you would have known that would be a risk. So the complexity is a good thing and a bad thing, but in general, for people interacting with it, it's usually a burden they have to overcome. But it also allows for new things that have never existed before, like flash loans, which is basically, I guess, a concept for another time, maybe in the lending one. But it's basically you can take a loan and pay it off within the same block, which isn't possible in the normal world. And now I just quickly have the volume split of volume between centralized exchanges and decentralized exchanges. I think it's probably pretty hard to estimate centralized exchange volume because it's not open and because there's over-the-counter deals and stuff like that. But you can clearly see that decentralized exchanges are kind of winning now just because of all of the advantages they have.
And also for centralized exchanges, there have been actually reports where the values have been exaggerated.
Yeah.
So
And
kind of, it's just essentially they say they had this much volume, but there's no real way to prove that it really was.
yeah, exactly. And that's one of the general cons of centralized exchanges is, yeah, it's not transparent and you have to sort of trust their numbers. So, but yeah, that's the presentation. If there are any questions, I know we're a little bit over.
Amazing. First of all, thanks a lot. I think this was very great and detailed. So really, yeah, it goes out to the audience. Are there questions on these topics? You want to make some comments? You have some general things that you want to ask, you want to know, as long as OX Hunter is still here.
First, I want to say thanks. That was a great presentation. And I guess at first sight or first hearing it, like from that point of view, it almost seems like it's kind of risky as a liquidity provider and almost not worth it. So I'm just trying to see, like, what can the protocol or the ecosystem do to promote, because it seems like it's so important to it. To get liquidity. So what can the platform do to promote that? Is it strictly on the fees or potentially putting, API-wide returns?
Yeah, so it's both of those things. But one of the big concepts that's coming out recently in the past year is something called protocol-owned liquidity, which is basically, and it's also, the method is referred to as bonding, which is basically a protocol will put aside a certain amount of their tokens, their native tokens, to sell to people for liquidity, a liquidity pair token. So at a discount. So what would happen was that people would put together token A to USDC liquidity position, and they could trade it to the protocol's treasury for the protocol's native token at a discounted rate. And so instead of giving like APY and quote unquote renting liquidity from by offsetting their fees by just emitting tokens, they can, for a higher price, because they have to give that discount to people, but for a higher upfront price, they can buy their own liquidity from individuals. And it's much better for the project too, because if they don't own their liquidity, someone else could just withdraw it and sort of put them at jeopardy.
Yeah, I also think
Nice.
we will have what we will very likely see when Shimmer, when the EVM chain goes live, is there will be quite a battle for liquidity. We will potentially have, I don't know, 2, 3, potentially 4 dexes go live in a short time. They all need this liquidity from our users, from the Shimmer token holders, so they are incentivized to reward liquidity providers with anything. Yeah, so either with some kind of LP token staking things, or with high fees, especially in the beginning of this whole thing, to establish a liquid market on an exchange. Somehow you need to incentivize people to deposit their position into such a pool. And there are not so much different ways what you can do. You can give fees. You can potentially give rewards in project tokens or something like that. But that's going to be the opportunities when such a market gets established and these projects spin up, because they need, if like we've learned that if they run around with very, very low liquidity and these pools are very empty, nobody will want to use it, because you will not be able to execute any useful trade there without big slippage. So they have to get people depositing liquidity there, and they will very likely spin up some interesting rewards for those that provide that. Yeah. Okay, any other questions? Any other suggestions?
I have one more question regarding pool balancing. Let's say I launched a token and held an ICO 100 tokens per dollar. So now, if I would do a 50-50 setup, then would that be $1 per token inside of the pool? Or would I maybe in this case choose a different weight, so there's more tokens, $2 in that pool?
Yeah, it depends how much liquidity you have. So if you have enough liquidity to do 50-50, as in, like, let's say you want to set the price of $1 per token, you want to put in 100 tokens, just for example, you, in a 50-50, you need to provide 100 of your token and $100. But in something like an 80-20, you need to provide 80 of your token and $20. And so that can be a good option if you don't have as much liquidity, to still allow people to trade, especially on the buy side. Like the 80-20, if the 80 is in your native token, the 20 is in USDC or something, because more of the liquidity is in your token, then it gives people more of your token to buy in that position, if that makes sense.
Yeah, and I think it's
because there's more of the token of my tokens in the liquidity pool afterwards, right?
Yeah, and I think it's also
Yeah.
for projects when they start, because basically, what do you have? You launch a project, you launch your own token, so you have a bunch of your own tokens lying around. But many projects have not such a high dollar balance lying on the sideline to provide a 50-50 pool. And so I think we will also see some pools spinning up, not with 50-50, so that basically you can get your tokens listed on such an exchange without having to invest or getting a loan on USDT to supply the other side of the liquidity pool. So I think that's an interesting thing for projects, for maybe also for smaller projects to start off with such a pool, maybe later on balance it to a more balanced thing. But for starting a market or starting a trading pair for your tokens, it's an interesting thing with some downsides in slippage and things like that. Yeah.
You already
Yeah.
asked the next question. Is it possible to change the balance of a pool later on? Say my token it's gone through the roof. It's now worth $100 each.
Yeah, I think it would probably be technically possible on a blockchain, but in general, what you would do in current decentralized exchanges is just withdraw the liquidity from that position and put it in a new position at a new weight. Like it would be a separate trading pair.
So you just set up
Yeah.
a new pool.
Yeah. Yeah.
There's a message in the chat.
Compounding interest. Is this a question or is this a comment?
Yeah. To answer, generally in the common model, yeah, it does compound because the fees that you make are on either side and it gets added to your liquidity position generally. Some platforms might make you harvest and redeposit your fees, like Uniswap v3 does, but most models like SushiSwap and things based off of the original Uniswap will, it just grows your position and then your position earns fees based on its size.
Okay. Anybody else? Anything? Okay. Maybe not currently. We will always be available if there are more questions coming up. Just post them in the general channel. This whole thing will be available as recording on the IOTA YouTube channel. And I think Alexander, this was great. This was a lot of insights. I think one takeaway definitely, like just from me personally, is like it's not a set and forget thing to be to do something as a liquidity provider. Yeah, you have to observe what's happening with your positions there. So it needs some caretaking. But it's a very interesting concept. I think it will be very interesting to see how this whole thing develops once Shimmer goes live and we have all these opportunities there. So great insights.
Yeah, thank you for having me.
Okay. So everybody, I would say fantastic. Let's wrap it up here today. We will have the next session on next Thursday, same time, 5 p.m. CEST, Berlin time. We continue with, I think, yield farming. And our friends from BanklessConsulting will provide more information, give more input on all this very, very interesting stuff that's coming towards our ecosystem. So thanks a lot, OX Hunter. Thanks, Marcus, for hosting this, and see you next week.
Yeah.
Bye bye. Thank you.
Bye.